But once you've decided on a level of factor exposure, what are some of the ways to approach assigning individual security weights to achieve that exposure?
Okay, so weighting scheme. So I think we're really getting into the weeds today. So I think that's definitely another important aspect to consider when it comes to portfolio design, right? Because we decide on the premiums, let's say size, value, profitability, but then there can still be many different weighting schemes, again, leading to very different portfolios. And in fact, we did a paper on 8 different weighting schemes that are commonly used in systematic equity portfolios and in the index design. I'll just mention a couple here. One is rank weighting. So essentially, you rank stocks on the factors you want, right? In this case, you have, say, a size rank, a value rank, a profitability rank, and you take the average of these ranks. And then you can say, well, let's assign the weight to be proportional to that average rank. And sometimes you also see, say, a z-score weighting, so meaning that instead of using ranks like from 1 to n, then you use the characteristics of related to those factors, but transformed or standardized into z-scores. And you also see some others with similar flavors. People sometimes call signal strength weighting. And of course, for a lot of the weighting schemes, there are usually many other moving parts and other constraints that will be placed on top of that. But I think what I described kind of capture the main spirit of some of these weighting schemes. And although the details are different, I think one thing that they have in common is actually that they break that link between market cap weights of the security and the portfolio weights. That's why in our paper we call them non-price-based weighting schemes, because the security weights will be just proportional, right, to the rank or to the z-score, regardless of how big or small the stock is to begin with. And the problem with that approach is that can lead to oftentimes very uncontrolled overweights in the smallest names. And then that weight will be taken from the biggest names, right? So that can also lead to very significant underweight in the biggest names. More concretely, we see in our analysis, sometimes you end up with, say, overweighting some of the small cap names by 50 times or even 100 times their market cap weights. And then for the largest stocks, the Mag 7 of the world, you may be holding them at basis points. So those deviations are definitely very much on the extreme ends. And some of them, the extreme deviation can actually produce shiny performance on paper, but those portfolios are just not practical, and that paper performance is very unlikely to actually survive the turnover and trading costs in the real world.
Can you expand on how Dimensional approaches assigning individual security weights?
Yeah, absolutely. That's definitely what I would like to go next, right? Because we feel like the non-price-based weighting schemes have those issues. And so what we think is a better way is to actually have a weighting scheme that's a little bit more tied or more tightly tied to the current prices and market cap weights. So that's why we call it a price-based. And basically, that's the weighting scheme that we use in our integrated approach. And internally, we refer to it as a multiplier approach. So it's a very nerdy term. So just let me explain. So what we do is, for the stocks in our eligible universe, we're going to independently sort those stocks by their market capitalization, relative price, and profitability. Right, a three-way sorts. And the intersection of this three-way sort will then form groups of securities or firms with similar characteristics. Right, for example, your mega cap growth high prop firms will form one group, and the mega cap value low prop firms will form another group. And each of those groups will then be weighted in proportion to their total market capitalization times a multiplier. And that multiplier effectively is what we use to control that group's over and underweight relative to their market, right? So if the multiplier is 2x, that means you're doubling the market cap weights in your portfolio. If it's say 0.5x, that's underweighting, right? You're half weighting the market segments. And we design those multipliers to kind of more gradually increase as we move from groups with lower expected returns to those with higher expected returns. And then within each group, we then hold those firms in proportion to their market capitalization. It's not the easiest weighting scheme to explain, I have to say, but I do think it has great properties in terms of your targeting of your higher expected return and controlling risk and cost. Maybe just to elaborate a bit more there, in terms of expected return, we all know that, prices change all the time. Expected return potential also changes all the time. So by tying your security weights to the market cap weights, the market prices, you're effectively considering that up-to-date information, right, about expected returns in your portfolio. So that's great in terms of targeting higher expected return. Now, second, on risk, earlier we talked about some of the uncontrolled, right, over or underweight. So this type of weighting scheme that we use can be very robust in terms of risk control, because it's essentially how much you are allowed to over and underweight is explicitly controlled through the multipliers, right? So for example, let's say a small value, high prof segment of the market, yes, it may have higher expected return, but it may only take up 1% of the market. We're not going to put half of our portfolio there, right? So you can have a more explicit control on your over and underweight. And lastly, on cost, in terms of turnover, the multipliers are more gradual. So that means as stocks migrate from one group to the other, the turnover tends to be more moderate and limited. And also remember, within those groups, we're actually market cap weighting them relative to each other. So that means you can actually take advantage of the natural rebalancing that comes with market cap weighting. And lastly, because earlier we talked about kind of customizing factor exposure and accounting for the interactions, we do think that this weighting scheme of kind of working with size, value, profitability directly, those three dimensions, considering them together, will give you better control over the exposure you want, versus say, okay, we only use the average rank, because you can see we actually have an example in the paper showing that you might have actually two securities very different. Maybe one is small growth, low prof, another being large cap value, high prof, but they may have the same average rank. But we actually want to deal with them differently. Maybe the small growth, low prof you want to exclude, the large value, high prof you want to overweight within large caps. Yeah. So to some extent, I feel it's a bit like, kind of working with like a pancake pre-mix, right? That's already all, mixed. You don't have too much control over, versus directly dealing with the flour, the eggs, and butter. So then you can still make pancake, but you can also make a sourdough, croissant. There's a lot more control over the exposure that you actually want.
Yeah, really interesting. So there's a three-way sort on size, value, and profitability, right? And then there's a multiplier, a kind of a fixed multiplier assigned to each one of those categories, and then stocks are sorted daily by those three dimensions, and then weights are assigned to the individual stocks. Yeah, super interesting. What about investment? Like you talked about the three dimensions that firms are sorted by. How does investment, the fourth dimension, factor into weights?
Yeah, absolutely. So the investment, that's actually some work we did a few years ago related to basic firms with high investment tends to have low expected returns, and we see that if you use the asset growth as a variable to measure investment, that's more of a catch-all variable that gives you good information about future investment. So what we see though is that the effect is mostly in small caps, and also it's not a continuous effect. It's more like a cliff-like pattern that we see. So for example, if you sort small cap stocks from those with lowest investment to the highest investment, kind of let's say deciles, the first 8-9 deciles, they're pretty similar, but it's more the last decile with the highest asset growth. That's where you see the big cliff-like pattern, basically a big decrease in the average returns. So because of that, we feel that is much more lends itself pretty well to more of an exclusion approach. So rather than using that as kind of as part of a multiplier, we're going to basically exclude those stocks with high asset growth within our small caps. Or any portfolios that hold small caps. That's kind of an additional exclusion that we did in addition to the small growth, low profitability that I used in the example earlier. So that's another exclusion we use. So I feel that's also kind of where kind of the research meets the implementation, right? You have the research findings, but then you also need to think about how you actually implement in the actual world, depending on the finding and depending on the behavior of the premiums.
Yeah, it's a super clear explanation. So there's a three-way sort, there are multipliers, and then there's an exclusion for asset growth. I know there are a couple of other, are there any other exclusions?
Yeah, so for small growth, low profitability, that's another exclusion we do within
Okay.
small caps. And then there's also kind of more like not, so these are more exclusions from our eligible universe, right? We're not going to buy them in the first place.
Okay.
But then there are also other short-term signals we use that's more related to buying stocks daily. So maybe there are certain stocks we want to delay buying if the stock is on downward momentum, let's say, or maybe has very high securities lending fee on special, or latest addition being reversals if it's also have done well recently in terms of our reversal signals. So those are the ones we might want to refrain from buying more, and then we can actually emphasize buying others. So definitely a lot of details when you think about combining all of these different signals. Yeah.
Yeah.